In this video, we want to share with you a very unique wealth building process we call the family banking system. The family banking system is designed to help people get control of the things they finance in their life and convert those or transform those debt flows into wealth. So we're going to help you transform your debt into wealth. How do we do that? Well, we have to understand more about the banking process. And we'll begin by talking about who controls banking. He who has the gold makes the rules. What do we mean by that? We mean that if you need to borrow money to buy a car, for example, you go into the local bank or credit union or financial institution, tell them what you want to buy. They'll tell you how much money they'll loan against it. They'll tell you the interest rate that you're going to pay, and they'll also set the terms of the repayment period. So they're in complete control of that. In order to avoid that, sometimes we want to pay cash for things. And there's a lot of people that will pay cash for a vehicle rather than finance it with the idea that they are saving the finance cost. But we make another statement in this process of educating people about the family banking system. You finance everything you buy. And again, people would say, well, no, I paid cash for the last car that I purchased. And that may be true. You may have paid cash for it, but did you actually save? In reality, you either pay interest or you give up the opportunity to earn interest. Either way, there's a cost. So let me give you an example of that. Let's say that you want to buy the car in the background here, and you've got $30,000 in the savings account, and it's earning 5% interest. Now, if you pull the $30,000 out of that savings account to purchase that car, you withdraw it, you will not receive interest on that ever again. No more interest forever. Now, here's the thing. You needed and wanted the car. We've got to have vehicles to get around for the most part. But what we're going to do is we're going to focus on the money. We're going to follow the money, not the actual asset. We're going to follow the money. So let's see what would have happened. You say, well, listen, I didn't pay any finance charges because I paid cash. But because you gave up the ability to earn interest, $30,000 at 5% over 5 years would be $38,288. That's an $8,288 cost. You gave up that ability to earn interest. In 10 years, it would be $48,867. $18,000 of foregone or lost interest that you could have had, all because you wanted to drive that car. So again, there's always a cost. There's always a cost. So what if you could create your own bank? We call it your family bank. Now, we're not talking about you building a brick and mortar bank and having all the, the furniture and the desks and everything that's involved in that type of a bank. But what we want to do is teach you how to use the financial services industries, the banks, and things that they offer to you, checking accounts, savings accounts, etc. We want you to use them to your advantage as opposed to theirs. So when we create this family bank, you're going to own it, you're going to control it. Well, what does that actually look like? Well, let's take a look first. We all have a banking system. We just don't call it that. And we've already partially capitalized it, meaning on the positive side, you're seeing we've got money in our checking accounts. That's a little bit of capital. We've got money in our savings accounts. We have cash on hand. We have available credit, IRAs, 401ks. There's capital there. You can access that through a loan against your 401k. But on the negative side, there is car loans, mortgages, student loans, credit cards, all the things that are liabilities in your life. So on the left-hand side is capital assets. On the right-hand side is liabilities or debts. Now, here's what you need to understand. It is what we call an open loop. And the financial services industry, it's a closed loop. And let me explain what I mean by that. Let's pretend for a moment that you bank with the same institution. They handle your checking accounts, your savings accounts, they finance your cars, they do your mortgage, they made your student loans, and you get your credit cards for them. Now, if you understand that there's only one pool of money in the world, and it's all the financial services industries, some are banks, some are credit unions, some are investment banking firms, but all the money is in the financial arena, the financial services system. So if we think about it as the bank that you use handling everything, that might make it a little more clear to you as to how this is a closed loop for them and an open loop for you. So let's look for a moment. Money comes from your paycheck, goes right into your checking account or into your savings account. But at some point in time, you've got to pay your bills. So you start making out a car payment, a mortgage payment, your student loans, your credit card balances. So you're sending money away from your checking account, away from you. We actually call this a wealth transfer. It's money that's leaving your checking account and it's never coming back. It's going to someone else and they're going to utilize it for their benefit. Well, in this particular case, the benefit happens to be the financial services industry, the bank that you're working with. So money came into your checking account, went to a car loan, but the car loan is with the bank that you deal with, so it stayed in their system. It's a closed system. Money is constantly going from one side to the other, but it stays within the system. Now, as a result of that, they're taking all of our payments, everything that we send to them, the principal and the interest, they're combining it with everybody else's payments, and they're making more loans. So they're constantly recycling their money, constantly leveraging it and building it up so that there's more and more finances and they're making more and more interest. So for us, it's an open loop. It leaves our checking account, doesn't come back for the bank. They just constantly recycle it. Well, what if we could utilize that same process? What if we could do that same thing and recreate for us a closed loop system? Well, there's a way to do that. Let me talk to you about that. Let's look at a traditional car purchase. Let's take that same car, same $30,000, go into the banker, and they're going to charge us 6% over 72 months or 6 years. Okay, that's pretty common today. That creates a $495 per month payment. That means that over the next 6 years, we're going to send $35,640 to that financial institution. Now, we're going to sell the car at the end of that 6-year period. In our example, we're going to sell the car for $10,000. Well, what that means is that we ended up with a loss of $25,640 of cash. We had the car, we needed the car, we drove the car. At the end of the day, though, as far as our actual money, we lost $25,640. But what if we taught you how to use the family banking system, and through that, we helped you understand what a wealth transfer is and how to identify a wealth transfer and then reduce or eliminate it? What if we taught you how to create capital? Because access to capital is the most important thing that as far as building wealth goes. We've got to have access to capital, either our own capital or somebody else's capital. All right. So capital creation. And then what if we taught you how to create greater financial efficiency? Having every dollar positions at its highest and best use. So it's creating the most benefits, maximum benefits. What if we taught you how to recycle your money the way that the financial services industries do? What if we taught you how to have every dollar that you have do more than one job, creating multiple benefits for you? Well, ultimately, we believe that you can create far greater wealth implementing these processes and applying them to your financial circumstances than you can by chasing return. And we'll share a little bit more of that as we move farther into this video. So let's look at the old way. Same $30,000, 72 months at 6%, $495, $35,000 to the institution, and we sold the car for $10,000. Over here on the family banking way. Now, here's where things get very interesting. Over time, we would teach you how to accumulate $30,000 if you don't have it already. If you do, then we can start out in a much different position. But once we have identified the wealth transfers, created more financial efficiency, put every dollar at highest and best use, and created the maximum benefits for you, at that point, we're going to do something entirely different that no one has ever shared with you before. And that is, we are going to utilize the banking system strategy. And that is this. We're going to recapitalize our bank. This is literally a family bank. This is a separate business. Now, it's not brick and mortar, but what it is it's an accounting process that will allow us to build wealth in a very powerful way. So we're going to take that $30,000. We're going to amortize it over 72 months or 6 years at 6%, meaning we're going to create a repayment schedule, just like we would have had over here with the financial institution. We are going to treat this as if it were a loan that had to be paid back every single month at $495. That means that over the next 6 years, we're going to put the same $35,640 back into the family bank. Now, the family bank could be a sock in the bedroom, it could be a tin can in the back room, back a yard, or you could use a savings account or some other financial institution or financial instrument at a financial institution. We actually think there's better places than to put it back into the bank. And we'll talk more about that in a few minutes. So we're going to sell that car for $10,000. That means we started with $30,000 in our account. 6 years later, we've got $45,640 in our account. So over on the left, we had a $25,000 loss. On the right, we have a $15,000 gain. Now, I don't know about you, but I'd rather have a $15,000 gain than a $25,000 loss. This is the power behind the family banking system, is that we start out in a powerful financial position and we increase our capital through the process of recycling dollars. So let's take this a little farther. The family banking system. Now, we've created a way to share this with you that is condensed. This is completely and totally arbitrary. We're going to show you 3 purchases over a 4-year period of time and how it would work if you applied this family banking system to your financial processes. These are purely arbitrary. In other words, you are in control. You can design it to work much differently than how we're going to show. But this was to help you get a feeling of how powerful this concept is. So let's say we've got the $30,000 and you decide you're going to purchase a car, $30,000 car. Notice we changed the finance period to 4 years or 48 months at 6%. That creates a $701 a month payment, or $8,412 per year is going back into our banking system. Now, we already know nobody wants a $700 a month payment for a $30,000 car. We get that. Remember, this is just an example. It's to help you understand the concept. Okay. So that means you had $30,000, you pulled it out, you bought the car, and then over the next 12 months, you put $8,412 back into the account. All right. Year 2, you decide that you'd like to buy a home entertainment system. $8,000, 3 years, 36 months at 10%. Notice we changed the time frame and the interest rate. Now, there's a reason you want to charge yourself a reasonable interest rate. And in fact, there's a reason you may want to pay yourself something closer to what you might pay on a credit card or some other financial instrument, because all the money that you charge yourself in interest goes back into an account that you own and control. So that creates a payment of $256 a month or $3,072 a year. So we had $8,400 at the end of the first year. We pulled out $8,000, left $412. Then we put the car payment back in and we put the theater payment back in. So at the end of year 2, we've got nearly $12,000 in our capital account. So what are we doing? We're recycling money and we're recapitalizing our account, building more asset in it, more and more capital. Okay, now we're going to move on to year 3. In year 3, we decide that we're going to buy a boat. Now, I don't think you can buy this boat for $11,000, but for illustration purposes, that's the number that we're using. We're looking at 2 years, 24 months at 10%. Again, totally arbitrary, creates a $503 a month payment. So there was $11,896 in the account. We pulled out $11,000. It left $896. We put the car payment in, we put the theater payment in, and now we've got the boat payment. At the end of year 3, we've got $18,416 in our account. We're going to start year 4. Year 4, you make a decision. You're not going to buy anything that year. You're not going to finance anything. So we start with $18,000 in the account. We put the car payment, the theater payment, and the boat payment back into the account. And now at the end of the 4th year, we have $35,936 in the account. So let's really review what happened here. So we just used the same $30,000. Remember, we started with $30,000 to buy the car. But over the course of 4 years, we financed the purchase, $49,000 in goods and services that we purchased using that same $30,000. We recycled the money, the funds. Okay. You just recovered, in addition to using the same $30,000 to leverage into $49,000, you recovered $35,936 in principal and interest that would have gone somewhere else. Plus, you now own, free and clear, a car, a boat, and a home entertainment system. This is a powerful thing if you understand what we just explained here. We leveraged $30,000 to purchase $49,000 in goods and services that we needed and wanted anyway. We started out with $30,000. Now we've got $36,000 in our account, and we've got these assets that we own free and clear. Had we have done it the traditional way, we'd have paid $33,648 for the car, we'd have paid $12,000 for the boat, and $9,200 for the theater. A total of $54,936 in total payments, which would have left our account forever. And you never get to earn interest on those dollars ever again. But the bank does. The bank does. This is why many of the tallest buildings in any major city that you go into are financial institutions, the banks, the credit unions, the investment banking buildings. It's because they understand how money works and they use our buying practices, our financing practices to build wealth for them instead of for you. What if we turn that around so that no longer does the bank get to spend all that money, but we do? This is why we encourage you to start your own family banking system. Now, where's the best place to store the money for your family banking plan? Well, you could put it in cash in a safe. That's one place to put it. You could put it in Passport savings. Typically, that's low interest and it's taxable. You could put it into mutual funds, but with market volatility, money going up and down all the time, you never know for sure how much you're going to have in there. So that's really not the best place to put it. We want a place where your money is safe, secure, growing at a reasonable interest rate, and is protected from market losses. We suggest something that many people don't understand very well. And in fact, it's so misunderstood that there's a number of advantages that people are not even aware of because of the bias that has been pushed out there. So we suggest life insurance. Now, you have to remember that most people need and want some life insurance anyway, but what most people do not know is that there are plans that are available today that come under a section of the Internal Revenue Code, Section 7702, and that section allows you to put a lot of money inside of an insurance contract, and that money will grow tax deferred and can be pulled out tax free. And it's not subject to market volatility. It's not subject to market risk. And as you put money in there, it keeps growing. It's guaranteed to increase in value. These are not your normal insurance policies. These are very specifically and specially designed policies that will enhance your family banking system. So it's an idea of utilizing a financial services product that will help have every dollar that you have that is employed in this process doing more than one job. We'll explain that here a little bit further on. So let's take this a little step further and give you an actual thought process here. So let's say that you wanted to buy that car, that $30,000 car, and you created a $495 a month payment. So those dollars, that $495 a month is going back to recapitalize your banking system. Well, If we took that $495 and we purchased a life insurance contract and we put that $495 into it, well, now we have $1 doing more than one job. In fact, in this particular case, it's doing at least two jobs. It's paying for our car and it's buying our life insurance. But it can do so much more than that, because as we put this money inside this contract, it is building significant amounts of cash values that can be used for future purchases, for future financing transactions. And it all can move in and out of this contract completely free from income tax, completely free from market volatility. And as the money goes back in over time, as we use this system to our advantage, all these car payments, all these student loan payments, everything that we finance in our life, if we're running all that money through this system and we're storing it inside of insurance contracts, ultimately we're going to reach a point where we have a significant amount of capital that has never been taxed that we can utilize to supplement our future retirement. Now, if you're young, that's a long ways off, but if you're in your 40s or your 50s, it's not that far away. And we want to build up a sizable amount of capital that you could use to supplement your retirement. There's many, many advantages, and that's another video that we're going to go into, but we won't expound on here today. So what ends up happening is now we have our car payment, buying life insurance, that is utilizing and building dollars for the future, and these are retirement dollars that can be accessed completely free from income tax. This is very, very powerful, very important. And it also means, as opposed to, let's say you built up a lot of money in a 401k. While you're working, the maximum you can get out of your 401k is $50,000. And then the government sets the time frame. You must pay it back in 60 months, and you must pay it back at an interest rate that the government suggests. Now, it's interesting that when you pay back a 401k loan and the government sets the interest, right now it's about 7 or 8% as of the time of this recording. But the interesting thing is the government forces you to pay it back, and they force you to pay it back with interest, but you get the interest. It goes back into your account. It's the family banking system in kind of a government-controlled way, okay? Well, we want to give you complete autonomy, complete ability to utilize the dollars whenever you want. And there is no maximum limitation. With 401ks, there's maximum amounts that you can put in. With these insurance contracts, there's no maximum. You set up all the repayment processes, the interest rates, the time frames, and so forth. So you are in control. The family banking system gives you control over the things that you finance in your life and gives you the ability to skip payments if you want, make double payments if you want, but you are in complete control of that process. So the family banking system is something that we'd like to help you understand more about. And so we invite you to contact the person that sent you this video and get with them so they can help explain how the family banking system will work to your advantage. And we're looking forward to assisting you in building your family bank. Thanks for listening.